Surviving the high-rate storm. Interest rates are rising, inflation is sticky, and market volatility is your new normal. What do smart investors do when borrowing gets expensive and cash becomes king? Welcome to the high-interest era, where yesterday's playbook won't cut it. Subscribe now for in-depth strategies to build wealth when rates soar. Understanding high-interest rate environments. Interest rates rise due to macroeconomic forces like inflation, central bank policy, economic growth, and employment data. The Federal Reserve, or central banks globally, raises rates to cool off an overheating economy or control persistent inflation. These rate hikes make borrowing more expensive, reduce corporate profits, cool down consumer spending, and shift investor focus toward income-generating and lower-risk assets. Historically, periods like the early 1980s showed high rates correlating with cautious investing and inflation protection mechanisms. When rates rise, bond prices fall, mortgages become pricier, and stock market volatility increases. Understanding these ripple effects helps investors reposition intelligently. Winners and losers in a rate hike cycle. Rate hikes tend to favor sectors with strong cash positions and the ability to pass on costs. Financials benefit from higher net interest margins. Banks and insurance companies often see stronger earnings. Energy companies also tend to do well in inflationary environments, especially when commodity prices rise. On the losing side, sectors dependent on cheap capital like real estate, especially REITs, and high-growth tech stocks typically suffer. Investors need to assess sector rotation strategies to capture upside in rate-friendly industries while avoiding those sensitive to rising costs. Fixed income investing strategies. Fixed income investing gets more complex in high-rate environments. Long-duration bonds are more sensitive to rate increases and can decline sharply in value. Investors may prefer short-duration bonds, which carry less interest rate risk and can be reinvested at higher rates over time. Laddering, investing in bonds with staggered maturities, can smooth returns and reduce reinvestment risk. Treasury inflation-protected securities, TIPS, offer a hedge against inflation by adjusting principal with CPI, making them attractive during high-rate periods. Equity strategies that work. Equities don't always suffer during high-rate periods, but investors need to be selective. Companies with strong cash flow, low debt, and pricing power are more resilient. Defensive sectors like healthcare, consumer staples, and utilities offer more stability. Dividend-paying stocks can serve as bond alternatives, offering consistent income and partial insulation from volatility. The focus should shift to value stocks over growth stocks, as the former often trade at lower valuations and withstand rate pressures better. Real assets and commodities. Real assets, such as commodities and precious metals, often perform well in high-interest environments. Gold and silver act as traditional inflation hedges and stores of value. Commodities like oil, agricultural products, and industrial metals benefit from sustained demand and pricing power. Real estate can be a mixed bag. Residential housing may cool, but REITs focused on industrial, data centers, or logistics can still thrive if they lock in favorable leases and maintain high occupancy rates. Using cash and cash equivalents. Wisely, in a high-rate environment, holding cash isn't just a defensive strategy, it can be an income-generating one. Money market funds, high-yield savings accounts, and short-term treasury bills offer yields not seen in decades. Certificates of deposit, CDs, provide predictable returns with low risk, and laddering CDs enables liquidity while capturing better rates. Strategic cash management allows investors to stay nimble and seize opportunities in volatile markets. International diversification, rising rates in the U.S., don't always mirror global trends. Some countries may keep rates low to stimulate growth, offering arbitrage opportunities for global investors. Diversifying into international stocks and bonds can reduce home country bias and hedge geopolitical or macroeconomic risk. Currency movements also play a role. Emerging markets may struggle with capital outflows, while developed markets could offer safe haven exposure. ETFs tracking global indexes or hedged strategies can provide access with risk management, tax strategies, and sheltering gains. Taxes can significantly eat into returns, especially in a high-yield world. Investors should prioritize tax-efficient assets, like municipal bonds offering federal tax-exempt income. Retirement accounts, IRAs, Roth IRAs, 401ks, can shelter gains from taxation while allowing compounding. Roth conversions during low-income years can lock in tax-free growth. Harvesting losses during market dips and strategically timing gains can improve after-tax returns in high-rate years. Outlook for 2025 and beyond. Looking ahead, investors should prepare for continued uncertainty. Central banks may hold rates high to combat entrenched inflation, and geopolitical tensions may exacerbate global disruptions. However, new technologies, reshoring of supply chains, and evolving energy markets will create new opportunities. Staying diversified, liquid, and informed is key. Investors who remain proactive, not reactive, will outperform. Learn to pivot strategies, reassess regularly, and embrace market shifts as chances to grow. Subscribe now for expert breakdowns and practical insights on investing through economic shifts. When the rules change, the smart investor adapts.